All right, now let's take a closer look at today's retail numbers from Target and Home Depot in particular. For that, we bring in Daniel Binder, an analyst with Jefferies, joining us from New York. Dan, welcome.
Hi, thank you.
All right, before we talk about these individual names, what are the underlying themes you're seeing in retail these days?
Well, I think there's a broader second derivative improvement in retail sales that was somewhat interrupted by comparisons against tax stimulus last year, and so we are seeing a little bit more disappointments through the Q2 earnings season. We saw that disappointment at Walmart, saw a disappointment out of Lowe's yesterday, and then Target this morning had already pre-announced their comp store sales, but generally had been running a little bit softer than expected. They more than offset that with better gross margin, which brings me to the second theme, which is better gross margin improvement. And a lot of retailers are benefiting from a few things. One, mainly lower transportation costs as oil prices and excess capacity in the industry drive prices down. But you're also seeing in at some retailers, deflationary trends allow them to take a little extra gross margin as the prices come down. So there's easy comparisons, better markdowns. There's a number of things that are driving better gross margin. I suspect that'll mitigate somewhat or dissipate somewhat, I should say, in the back half of the year. And then lastly, you're seeing great expense management, I think really unprecedented versus what we've seen in prior cycles.
When you talk about the expense management, how much more cost cutting can these retailers actually do before they absolutely have to get a bump up in sales, a bump up in traffic to really solidify that bottom line?
Well, I think you hit on an important point there. If you think back to last fall when sales really started to take another dive downward, you saw a lot of retailers react very quickly. So I think what we're going to start to see is, as we move through the rest of this year, expense beats will be fewer and farther between. You'll probably have to start seeing top line drive earnings growth, and that may just initially be less negative, but I think relative to expectations, if the numbers are coming in better, the earnings should follow.
Dan, I spoke to an analyst last week, and he told me something I found rather striking. He said if it comes down to a game of chicken between the retailer and the consumer, the retailer is always going to blink first. So going forward, especially into this back-to-school season, how much cutting can they do?
Well, it's interesting. We've heard from both Walmart last week and Target today that the back-to-school season is actually pretty good. So far, we're seeing things improve. Both Walmart and Target talked about trends being better. While home improvement is not part of that back-to-school scene, you're also seeing some sequential improvements there as well. So I think part of what we're seeing is the lapping of tax stimulus. Part of it is some additional spending on back-to-school. And what's interesting is a number of the retailers that we've talked to are saying that the back-to-school pricing environment is actually a bit more rational than what we've seen in recent quarters. So that's encouraging from a margin perspective. I think good inventory management ultimately means less markdowns, and so the consumer may have to move a little bit more quickly than they did last year to get the goods that they want.
In reading, Dan, some of your comments about Home Depot, you say what's key here is the way Home Depot outperformed rival Lowe's, saying that's really a change from prior quarters. So how did Home Depot do that in particular? And then is this performance sustainable? You do have a buy rating, I should mention, on HD.
Yes, that's right. We actually upgraded both Home Depot and Lowe's in mid-March when we upgraded the retail group overall. We have indicated more recently that we thought Home Depot would probably outperform Lowe's because of this expectation that we had that they would outperform Lowe's on the comp store sales. Now, at first blush, I think the regional performances or the regional exposure that Home Depot has explains part of it. They are over-indexed in markets like California, where Lowe's is under-indexed in terms of the store base and the exposure they have there. Yeah. Meanwhile, Lowe's is over-indexed in some of the markets where we're seeing some deterioration in parts of the central U.S. and Southeast.
And Dan, we have about 30 seconds left. Tell us about Target.
Well, Target, I think you look at the comp store sales performance relative to Walmart. It narrowed a bit in Q2. Some of that is probably explained by food deflation at Walmart, which has a greater mix of food, and some of it is explained by Walmart's greater benefit from tax rebates a year ago. But I think directionally, as we come out of this recession, we're going to see discretionary goods pick up at Target, and I fully expect that comp gap could narrow further. In terms of the next leg of this year, we've got, I think, a really good chance of seeing potentially positive comps by the end of Q4.
Dan Binder of Jefferies joining us from their offices in New York. Dan, thanks so much.
Thank you.